that the market, I think, broadly speaking, is pretty complacent about the way this conflict is playing out. We have seen these, let's call them skirmishes in the past, and it seems to get resolved by Monday's market open, and initial reaction's negative, and then the market we've seen comes right back. I do wonder if this becomes maybe a little bit more of a concern. It doesn't necessarily have to play out in terms of a big decline in equities, at least just yet. But, when you have this type of prolonged campaign, you end up having this digging in by both countries. And I don't think that's something that can be easily stopped at least from what I'm seeing. So oil is going to tell you what the real mood is. Oil is clearly still telling you the risk is very real. And if oil were to continue to move like this, there's going to be a juncture where it's going to cause a real freak out for asset classes.
So, Mike, I know that you watch the next three things I'm going to bring up very, very closely, right? The action and moves in dollar, in yields, and also in the yen. What are they telling you right now about whether or not they're pricing in this escalating conflict and the risk of either the conflict going regional, broader, or for that matter, oil hitting? I mean, J.P. Morgan this morning, I think, was calling the potential, the risk, flagging the risk of $130 a barrel oil.
No. Yeah, I mean, look, the initial reaction by the Treasury market clearly suggests that this is going to be inflationary. I would caution on that viewpoint, because if oil were to continue to spike, I'd make a case that that's actually disinflationary or deflationary, because typically with a lag, when you have a very sharp move in oil, you tend to have a recession follow afterwards, because companies can't react fast enough for that cost push inflation to show up in what they're selling. So it remains to be seen how this is going to play out. I think if Treasury yields start to drop in any kind of meaningful way as oil is rising, that suggests that the market is starting to prepare for this being a real drag on the economy that might finally force a flight to safety trade. And the more that oil continues to push higher, the more it puts Japan and the reverse carry trade back into play. I've been on that theme for a while. A large part of this thesis that you end up having this deleveraging of the carry trade is very much contingent upon the price of oil, not priced in dollars, but priced in yen. And if oil were to spike further against a yen that is still relatively weak compared to what we've seen, even though it does look like it wants to strengthen, that would suggest that you might have a repatriation of leveraged yen that have gone into other assets globally, and that might finally cause another sort of August 3rd, August 5th of last year moment where things just break down very aggressively. So everything's interconnected when it comes to markets. I don't think you can look at anything in isolation. It is a very globalized environment for fund flows and for asset flows. I would just caution under the idea that there's going to be a deal, like Trump is saying. I don't know if you want to make that an actual investment thesis.
Dan, come in on this.
Mike, it's Dan joining the conversation. Here from DC. So tell me this, how do you want to be allocating then in this environment, particularly if, as you say, equity markets are mispricing or maybe underpricing the risk of a wider regional conflict? And perhaps even if we see, triple-digit oil again or near to it, the inflation trade also coming back?
Yeah, I mean, the simplest answer is the right one. It's probably through energy, right? Through energy stocks, which, as a percentage of the S&P 500, is relatively low weight compared to its own history. I've teased out on X on my @lead lag report handle that you maybe could see a repeat of 2022, where most of the market was down except for one sector, which was the energy sector, diverging completely from everything else during that bear market. So it does look like the energy sector is underinvested, and that likely is going to cause some outperformance. The question is, of course, how wide of that outperformance. That happens to be the largest sector allocation in the free markets ETF, which I just launched with 3 other partners last week, FMKT, because energy benefits from deregulation independent of what we're seeing with this geopolitical conflict. I do suspect that if oil does continue to rise and the conflict gets worse, that Trump's going to put even more measures on the deregulation side, so pushing further towards this tailwind towards energy. Gold clearly does seem to act like the anti-war or like the war hedge, and we've seen gold respond when you have these strikes. So gold probably, as much as I myself have been concerned about that in terms of that becoming a momentum trade, probably does become another possible hedge. Also, by the way, in the FMKT ETF. And then the curious one's going to be Bitcoin. I think we could actually be at an interesting juncture where Bitcoin actually is seen as a hedge as well. If things get even more crazy, meaning that you could see Bitcoin diverge from typical risk-on behavior. Selfishly, again, I'm saying that because Bitcoin's also in the free markets ETF. So I'm kind of talking about my own book here, but I do think that those parts of the marketplace probably are the most intriguing. One thing is I'd say is I'm most confident on is if things really get out of hand, you probably don't want tech because tech's been one of the winners, and the marketplace will use that as a source of liquidity under uncertainty.
Let me just go back to what you said about gold as well. Of course, it is the safety trade du jour and has been through previous Middle East and other global conflicts. Do you think gold is looking a little expensive at around 3,500 USD an ounce?
Yeah, I mean, look, I was quite bullish on gold from August or October 2023 up until maybe 3 months ago. It's in the free markets ETF because it's a quintessential example of a free market, right? Just like Bitcoin is. Gold's been consolidating on a sideways basis. Looks like it does want to break out admittedly. So that pause in the momentum may now be over for all we know, and this could be the catalyst. But I think the question of expensive is a tricky one, right? Something's only expensive if people are not willing to pay for it. If people are willing to pay for it, it's cheap.